Mas tem que ver se eu consigo ler esse negócio aqui. Pô, tá longe pra cacete. Hello.
Nice to meet you.
Very nice to meet you. Where are you from? Okay. Ladies and gentlemen, can you start the mic? Okay. Good afternoon. Thank you all for coming. It's always nice to have standing remotely attendees. I'm Danny Leipziger. I'm a professor at GW and managing director of the Growth Dialogue, and I spent a few years in this building and others like it. Without further ado, this is an important topic which I will introduce, and I'll introduce the panel to you. But I would first like to ask Joachim Levy to begin this seminar.
Thank you all for being here. On the behalf of the World Bank Group, I would like in particular to welcome this wonderful panel to discuss one of the key parts of our goal and our strategy to come from the billions to trillions that we had committed and adopted as goals in Addis Ababa in 2015, and to which no doubt the national development banks are crucial components. But although they are so important, they have not been a real central part of the debate. And I hope that this is changed today, because we have to alter this debate and have the key the national development banks really integrating and informing our strategy as an international community to achieve these goals. And in particular, we remember that one of the big changes that started there was the participation of the private sector. How we can really mobilize the resources of the private sector, both domestically but also across borders, to help us to achieve the SDGs. The role of national development banks is really multifold and extremely important. In many countries, they have had a very important counter-cyclical role, including in the recent global financial crisis. One reason why some countries were able to really go through this crisis without too big a shock has been the support of development banks, national development banks, and of course in development in a broader sense, where both working domestically, but many of them also increasingly working on third countries, the contribution have been very notable. In particular, of course, when we think about the enormous infrastructure gap, the infrastructure has the characteristic that they are big, they're complex, they need coordination, and to have the structure, not only the money, but usually the staff, the structure, the stamina of development banks is absolutely essential, including when we want to bring the private sector. It's not that sometimes the main role is not only lending, but really helping to structure, sometimes help to take a certain amount of risk that the private sector doesn't have the capacity to hold. And I think that it's in this context when we think about this new paradigm of growth that has been, ratified at the G20 at the Hamburg meeting in July, when you had all G20 countries with the participation of many MDBs established these principles that basically would say that given that we need the amount of private sector money to to reach the SDGs. You should have some discipline, some criteria of seeing how we approach projects. And there, what is established, with of course nuances and the common sense, but whenever you see a project, you first look to see if it can be done by the private sector, if it does require some additional support, planning money, or risk absorption from the public sector. You also try to influence the environment, change the whole business environment where this project develop, so that with all of these, you're using what are ultimately very scarce resources from the public purse. So there is an actual strategy with different steps that allow us to really use the money where it's needed. And in some projects, we have to be supported fully by the government or fully by the public sector through development banks. But I think that understanding this better, debating the nuances and the different approaches to which we can do, not only we have a similar debate with multilateral banks, but they are fundamental partners. And you can say that because the World Bank actually participated in the creation of some of these banks. We often offer credit lines. We very frequently also do projects together. We do sometimes could call technical assistance, but actually is working together. We have here the director, senior director of financial and markets, FNM, who is involved with many of these banks, supporting as well as our treasury. So we are very close partners, and like any partnership, we learn from both sides. So I'm extremely excited with the opportunity of starting this dialogue, and I think we should start it. So thank you very much. Danny, please, let's start.
Thank you very much. Well, welcome again to this roundtable on the role of national development banks in promoting sustainable and inclusive economic growth. We had a big difficulty in getting this panel together, mostly around the shape of the table that we would use. And we consulted Kissinger's Paris Peace Talks with the Vietnamese, and we discarded that. We went through a U shape, a V shape, and finally we decided on this long row of people whom I can't see so well, but I will try to moderate this session. So the question that I bring to the table is, so why are we having this session? Joachim gave you some very good reasons having to do with the SDGs, etc. My view as a development economist is basically that most capital for development purposes is domestically generated, right? It's not ODA, and it's in most cases not from outside the country. So the real challenge is, how do you mobilize these funds? How do you crowd in the private sector in many countries where savings rates are decent? Of course, the World Bank and other institutions can nudge, to use a word that's famous in the last week, people to behave in certain ways. But at the end of the day, we're looking for development impact, and we're looking to development banks to help us with this. So for our discussion, we have a very illustrious panel. You, I hope, got their bios somewhere, so I don't have to go through all of their honorary degrees. But we have Clemente de Valle from Colombia, from the Financiera de Desarrollo de Colombia. Clemente brings a lot of experience from the World Bank, from the private sector, and from government. We have Patrick Lamini, who is head of the Development Bank of South Africa, equally talented CEO of a very important regional development bank. We have recently arrived Joachim Nagel. How are you? He is on the executive committee of the Kreditanstalt für Wiederaufbau, KfW. Now, why it's Wiederaufbau, which means reconstruction, I don't know, because Germany is certainly well constructed. But I'm sure he'll tell us about that. And last but not least, on the panel, we have Shahruddin Zainuddin, recently appointed, last month in fact, as president of the Development Bank of Malaysia, known as BPMB. So we welcome you. Equally, we welcome three commentators who have equal standing here on the panel. And they are Ambroise Royol, who is well known to many of you from being on the boards of the fund and bank. And he's now the VP at European Investment Bank. Rémi Rioux is at the other end, and he is head of AFD, the French Development Agency, well known to you all. And representing the private sector. So let me start off and ask a couple of questions, and we have sort of allocated them. So the first question will go to sort of like a talk show. It'll go to Mr. Zainuddin from Malaysia, Mr. Lamini from Development Bank of South Africa, and then a comment by Mr. Rioux. And the question is, how can NDBs, National Development Banks, work better with the private sector, with partners in the private sector, to mobilize funds? Basically, you'd like to see them crowding in capital for development purposes, and also, and particularly for the two heads of development banks, how do you operate across borders? Because this is one of the big constraints to development in a lot of parts of the world, that the real rates of return on good projects involve cross-border sales of electricity or cross-border transport, etc. So how can we get the better impact from these NDBs? So I'll start with you, sir.
So thank you very much. So yeah, I've been in the job for 1 month.
However,
the bank has been around for 43 years. So it has a lot of experience in terms of, in fact, building Malaysia. Many of you have been to Malaysia, and I think you've seen some of the development work that has been undertaken by the government. I think, so just to answer the question, we all agree that for a development bank to operate, it must have a well-defined mandate, and then it must have, without any political interference and so on and so forth. But I think there are two key ingredients where, in order to crowd in the private sector, which is I think quite missing in the area, is that we don't have very sophisticated risk management tools within development banks. So because of this, typically when we crowd in the private sector, what the private sector is looking for is essentially government guarantees for them to participate. Now that, when you do that, it defeats the purpose, because essentially the government is guaranteeing the projects for which the private sector is then funding. The way that we need to move towards is that where, even for ourselves, the development bank, whenever we fund projects, we ask our government, our own government, the shareholder, for guarantees. So it almost defeats the purpose. Right? So I think we need to find a way, because governments can't continue to provide government guarantees, because this is affecting their credit rating, as you know, it affects their balance sheet. So we have to find another way, and I think the private sector and the development banks have to work together to break up the risk. I think there's enough talking about these points, but we need to bring in a lot more private sector techniques of being able to manage risk and being able to share this risk. So that's one. Secondly, we always look at the development banks being able to look at the projects and be able to evaluate them. And what the role of a development bank is, in fact, to look at developing. However, what is missing is that how does a development bank report on its development objectives? There are actually no separation between in this format, right? Because at least if I speak from Malaysia, if you look at the annual report of our development bank, and in fact all the development banks in Malaysia, they look the same like all the commercial banks. So how would a private sector be able to tell that the development banks have in fact been able to achieve their developmental objective? Now, the only way they can do that is to look at purely at the financial objective. But surely the development banks have more than just financial objective goals, right? They they definitely have a developmental objective goals, but we haven't yet developed more comprehensive tools, quantifiable tools and techniques to be able to be transparent and to allow the private sector to be able to judge where would they want to put their money into, right? So I think this is two key areas. If we can work together to achieve this, I think it will help significantly to be able to crowd in private sector funding. Now, as far as cross-border, our mandate doesn't allow us to actually fund outside Malaysia, so I won't be able to comment about cross-border. But I think if these principles are correct, meaning that if we're able to establish these two things, risk management, proper risk management of development banks projects, and secondly, transparency in terms of reporting of developmental objectives, then going cross-border would be the next frontier, right? That shouldn't pose such a big problem. Joachim mentioned that typically infrastructure projects are very complex and complicated. So the third area of gaps that we see is that even though, as he mentioned, infrastructure projects are complicated, when you look at the structure, financing structure that we typically use to finance the infrastructure, they're very simple structures. They don't really incorporate what you would have in the private sector, much more of the sophisticated merging of different types of financing structures. So this is another area where a lot of the techniques and experience of private sector needs to be brought into the development sector to be able to structure the loans in a much more sophisticated way.
Thank you. I think both of the first topics you mentioned, risk mitigation and how do you measure impact, we will come back to at the end and we will discuss. Mr. Lamini.
Thank you very much, Prof. I think it's quite important that you see more and more, as Joachim actually said earlier on, about the need for the national development banks to work very closely with the multilateral development banks because we have a common mandate. We always say our mandate as the development banks are always that actually of bending the arc of history towards shared prosperity. And we, as the national development banks and the multilateral development banks, we are much more closer to the politicians who make certain regulatory decisions that are quite important for the private sector to understand and to be compatible with. We, as the national development banks, have patient capital together with the multilateral development banks that the private sector and asset managers do not have appetite for. We also have risk capital that we are able to put forward in the early stage preparation and doing feasibility studies for projects that the private sector as a sponsor might be able to, might want us to work on. And given the fact that as NDBs and MDBs, we tend to appreciate the political landscape better than the private sector, and given our proximity to the politicians, we are able to crystallize political risk and regulatory risk and be able actually to engage much more effectively with the political principles to make the project much more possible. But the private sector has got the skill sets. As Zainuddin actually said earlier on, for any project prep and feasibility studies and the structuring skills, the abundance of such skills tend to reside largely and primarily with the private sector. So our cooperation and working together can be able actually to make sure that projects that would otherwise take very long to happen can happen much more quicker. But private sector need to be comfortable in terms of the public-private partnership regulatory frameworks that enables them to work together with government and also to take away the burden from national fiscus. So to make sure that projects could be undertaken by the private sector off the budget of the national fiscus. It's an extremely important collaboration, but we are also seeing more of this. As DPSA, we have a mandate that actually allows us geographically to go beyond South Africa and to go into the rest of the continent. We have done a number of projects, like one, I can start in South Africa, where we had the Independent Power Producer Program for the renewable energy. It was one successful project that even the United Nations actually commended as one of the global successful projects. And again, this was a project well facilitated by government of South Africa and well cooperated with between between the national development banks and the private sector. Effectively, actually, the private sector were literally falling over each other to try and get into these projects. And in Tanzania, we had the Central Corridor projects that was trying to link the 5 countries in the Central within the Central Africa. But working together with the World Bank and ourselves and some of our sister DFIs, we were able to make what could have been a very difficult project possible. And today it has been awarded to a Turkish company. The construction actually is happening. We have many examples also as part of the International Development Finance Club. As national development banks, we are really trying to cross-pollinate each other and to share our experiences and to share various know-hows so that we can be able to undertake our mandates in our respective geographic areas much more effectively. There is actually for SDG to happen, as DBS we're also hosting the SDG Sustainable Development Investment Partnerships, which has about 38 partners across the world. And again, the idea there is to say how can we play a catalytic role in making sure that the practitioners on the ground can be able to work together. We also have philanthropic organizations that are bringing in grant funding and concessional funding to make actually projects and sustainable projects very possible. So it's quite interesting that SDG has got a much more better chance of succeeding because of the global cooperation, both in terms of the multilateral development banks, the national development banks, as well as the private sector players in terms of commercial banks, asset managers. Rodriguez is here actually going to be taking that through us through that. But it's really, really quite an exciting picture that we are seeing now, as Joachim said earlier on. I'm very excited about the possibilities. Thank you.
Well, thank you very much. I think we'll come back also to the cross-border issue because, as I remember, only a small fraction of IDA's resources are available for cross-border projects, and so finding other sources that can work across borders is indispensable. Patrick, you mentioned the International Development Finance Club, and I think, if I'm not mistaken, the gentleman to your left has some affiliation with that in addition to being head of the French aid agency.
Well, the 3 of us.
So perhaps you can comment on this.
Just thank you. Very, very proud to be here today. I really see, as Patrick, national development banks as I would say, a third pillar or a third dimension of development finance, more and more able to transfer international priorities deep into our national fabrics. And this is a key role, and this is really what the SDGs agenda is about. I mean, having this extraordinary convergence between domestic and international financial institutions. So, for instance, I see Agence Française de Développement as a national development bank. Probably you know that we are not a pure international institution. I mean, as you know, maybe we built a very strong alliance with Caisse des Dépôts et Consignations, which is our own national domestic bank. We are connecting our networks. We are building new financial instruments together. We are exchanging staff, and the idea is really for this group to express the French development experience and share it with others. Second comment, maybe, I'll be short, is that, of course, national development banks are working with MDBs, they are working with the private sector, but you have to understand that national development banks are working together. And this is what this group called IDFC, gathering 23 national development banks, is about. So it took strong position on the climate side, but it is also developing deals together, reinforcing capacity, taking position together, and of course the sheer size of it. IDFC is about more than $600 billion a year, 100 for climate already, And if we coalesce, if we work together, we can certainly make a difference in implementing SDGs. So this is the beauty of the world, the new world we are in right now. I used to call it polylateral, which means it's not only multilateral, it's not only bilateral, it's not only national, it's not only public, it's not only private, but there are many, many, many more options on the table that we should mobilize to finance what we haven't succeeded in financing for now.
Well, it's very interesting, and I think we can come back maybe to how these 23 national development banks interact, because it would seem to me, off the top of my head, that some risk diversification could instantly occur between these 23 national development banks that work in different regions. We'll come back on some of these issues, but I want to now move to a second question that the organizers have proposed. And that's basically to look at some of the design features of national development banks. What particularly has made some national development banks effective, and effective in the sense of mobilizing funds efficiently and well. And I'm going to ask Clemente del Valle from Colombia to start that discussion, and then there's a part two to the question that I will come back to. Clemente.
Thanks, Danny. Well, I think the case of Colombia, infrastructure was clearly one of the biggest challenges that we had. I mean, clearly Colombia had fallen behind seriously in the area of transportation. And there were two major market failures. One, it was very difficult for the government itself to be able to provide all the funding for such a huge program. Second, the kind of financing you needed in order to mobilize private sector was project finance type of resources, long term, and financing willing to take project risk. I mean, so these particularities made this large program, an 18 billion program in toll roads, PPP, availability payment design type, to be funded during 3 years, made it necessary for the government to rethink and a little bit out of the box of how could they use an institution to really help catalyze that mobilization of resources. So we knew that we needed an institution that was a catalyzer, not a crowding out. I mean, so it needed to be an institution that could lead the way, especially for the local players, for the local banks and the local capital markets, who were not familiarized so much with project finance. So it had to be an institution willing to take more risk in some cases compared with capital markets, to introduce and promote international standards of project finance, and also to facilitate the entry of international players. Colombia, this was a new contract, new framework, so the international banks and international capital markets would feel much more comfortable if they could come hand in hand with an institution close to the government, but credible in terms of its knowledge and its capacity. So that was the issue we wanted to address. So what did we do? I mean, we decided to design a new institution. We took over an existing development bank for energy that was basically in the freezer, and we transformed it. We transformed it into a specialized infrastructure institution that has more aspects of a private institution in the sense of have a private regime and have relatively important independence from the government. We were going to do first-year lending. So as you know, history of first-year lending from development banks, usually everybody was a little worried that first-year banks can actually end it financing important projects, but not necessarily profitable or viable projects. So we had to guarantee that this was going to be done really independent from political pressures to the project. So we had to look for shareholders, new partners on this. So we were able to invite the IFC and CAF. And later, IFC brought Sumitomo, which, with the government, with 67% owned by the government, and I will say the government of Colombia was courageous and decided, I'm going to sacrifice control in order to get what I want, which is a specialized institution capable of leading the way to attract the additional financing. So one thing was the governance, which was the policy. I mean, we don't finance more than 25% of any given project. So our challenge is how we bring the other 75%. So it's not just putting my 25, it's my success is measured by my capacity to mobilize the other 75. Then the private regime allowed me to bring the right kind of people, skillful people, and retain them. Because at the end, like any World Bank or IFC, they know. I mean, this is a people business. So if you cannot get the right people, retain the right people, you won't be able to lead the way. So by having this private regime and having a stable structure, that is not changing every 4 years based on the government, because I'm not appointed by the government. I'm appointed by a board that is majority non-government. So that gave sort of the stability for good people to be attracted to come. And I think that's some of the elements that made the institution able to start leading the way in a very quick way. In basically 3.5 years, we have basically become one of the key institutions in the local markets and a key interlocutor for the international players. And in that sense, we do feel that that framework, that particular design of the institution has helped us really achieve the goal of what we want. And maybe in the next round I can tell you a little more about the products, because clearly one of the key aspects of what we've done is developing products that helps the mobilization of those resources. So that's a lot of the success lies in the innovation, the products to help that money mobilize towards infrastructure.
Well, thank you very much. I said I would follow it up with another related question, and I want to pose it first to Gerardo Rodriguez from BlackRock, and that is, what are the means by which the private sector can be drawn further in to partnering with development banks? Everyone wants to crowd in the private sector. That you're the representative of the private sector here, so everybody wants to crowd you in. And the question is, how amenable are you to that?
So the answer depends on what specific sector is it that we're talking about. One which has received a lot of attention is certainly on the infrastructure side, just because of the huge need that there is out there for new infrastructure. So the challenge there, when one thinks about the massive infrastructure investment needs, is how to turn a need to an investment possibility, because there is a big gap between the two. The fact that there is a need does not imply that it is something where the private sector can participate. So state development banks can certainly play a role in that regard, which has to do with all the work that is not very sexy. It is not something that gets a lot of attention, but it is perhaps the most important element of an infrastructure program, which is how to close this gap between need and opportunity through the creation of a strong pipeline with sort of clear guidelines, private sector type of standards, and projects that are financeable by the private sector. So clearly there, it is a bit of a role of a government, but it is also, to some extent, a role of the State Development Bank as an operation arm of the government. When it comes to BlackRock, for example, the only two countries where BlackRock has a direct infrastructure investment capability is actually Mexico and Colombia. And the underlying common themes there that have been very relevant for an institution like BlackRock was a pre-established commitment by a development agency or a state development bank to participate at the same risk level of a private institution as a way to signal long-term commitment and a programmatic approach to infrastructure investment. This programmatic approach is the biggest challenge that any country faces, because it is where all of these elements that I mentioned come together. You need to create a sense of the potential for scale in order for all these private institutions, be that asset managers, banks, and so on, to invest the amount of money, time and resources to understand how to navigate the local dynamics in order to participate in those projects. But you need to get a sense of scale before you can actually make that commitment. And an infrastructure program could benefit a lot from a strong participation of a state development bank, but it has to be hand in hand with the government.
So that's a good lead into the second half that I was going to ask Clemente on the products, since Colombia is one of the two. I mean, Mexico, that's Gerardo, because you're from Mexico, so I understand why BlackRock is in Mexico. But Colombia is maybe a little different. So the question is, what did you do? If they're one of your investors, how did you handle it? If not, what products do you have that would attract the private sector? Gerardo says, you know, they would like to be treated equally in terms of risk sharing. So how do you structure products like that?
Actually, there are two sides. I mean, one is what Gerardo mentioned at the beginning, supporting the structuring of bankable projects. Because at the end, if we don't have good projects, there's nothing else we can do. And I think in Colombia, we actually created two institutions. One, which is a specialized PPP agency for transport at the national level. And then as we decided to take the remaining elements of infrastructure that was needed, so we decided to support the big cities in their big infrastructure programs. So we became the arm to structure complex projects that needed private sector participation. So, you know, a PPP project is a much more complex project to structure, and that requires skills and requires people who knows how to do it. So there we've been supporting clearly with the intention of attracting private sector participation. But the second one, and clearly is our core business, is financing. And there, as Gerardo said, the important here is if the government is just going to provide long-term rediscount funding, it's just giving funding, it's not taking risk. That works for certain sectors, certain industries, certain risks. But in this particular case, we needed to be the ones willing to share the same kind of risks than the big investors like BlackRock or like big international banks. And in some cases, that's why, for example, we developed a debt funds, which has been very successful for us because we were able to create like 3 new specialized infrastructure banks through the debt funds managed by specialized funds, like BlackRock, one of them. We were the promoter, the investor, initial investors in many of them, and they wanted us to see us there, you know, being the first to be putting the money there, believing in what we were doing. The other role was with more shy investors like local capital markets. There, obviously we understand they were more risk averse, especially to participating in projects in the initial construction phase. So we needed to mitigate. We decided not to do what Chile did in the 90s, which was completely eliminate the project risk through the monoliners, using monoliners. Now monoliners don't exist. So we believe here it was important that not because of the infrastructure, they disappear for other reasons, but it was important that the investors start understanding project risk. But we decided to mitigate part of it, to make it a little bit more applicable, a little bit less risky, and get them in, and that was part of the products that we designed as well, to make those instruments, those projects a little more attractive to institutional investors, local institutional investors particularly. And that clearly was the other component. We developed special guarantees structures, you know, tailor-made for the projects, tailor-made for this contract. Basically, we learned from the rest of the world. I mean, and we designed our own product, and has been quite successful in generating that attraction of local capital markets.
Right, great. Okay, I want to involve our last 3 gentlemen on the stage up here, Mr. Nagla, Mr. Levy, and Mr. Fayol, around the development impact question, on the theory that it takes a village to get anything done. It takes a lot of development players, a lot of institutions collaborating to maximize development impact. And so I'd be interested in your views on how one can foster some sort of deeper collaboration among the various players, and how, in the case of KfW, because I think we'll start with you, Mr. Nagel, you've been able to do that, then Joachim, and then Ambroise.
Okay, thank you very much. Let me come back to your question at the beginning when you asked why KfW Banking for Reconstruction. I should explain this to you. I guess you all know there are two institutions in Germany, and it's also part of my question, don't be surprised, that are 70 years old, or close to 70 years old. It's Deutsche Bundesbank, the central bank, and KfW. KfW was established after the Second World War from the Marshall Fund to rebuild Germany. And I work for both institutions. So I'm a former central banker, and central bankers love to have stability, but I will come back later to this. I think KfW is unique. I think we are doing domestic business for many, many decades, as just mentioned, and we're doing the same, more or less, in the international understanding. So the expertise we have on the national side is more or less transferred to the international side. So we provide refinancing, but also expertise to NDBs. And on top of that, I believe with our knowledge we have for so many years, we also try to help the NDBs to really more or less set the standards, understand the standards that are internationally important to really have the right programs in place on the national side. I think it is an important issue to bring the expertise you have over so many years to the NDBs worldwide. So I come back, as I said, as a former central banker, I really love to have stability. And I really see the whole, I'm new in the business, so what I see, I'm now here with KfW for close to 12 months. My understanding of how to evolve developing countries is a more holistic approach. It's not just doing one element or the other element. I think if you want to get let me say, a robust effect on developing banking, you have to integrate every element. You have to create jobs, you have to have more education in the countries, you have to provide funding. When I come to funding, just to give you one number, there are more than 50% of small and medium-sized companies in Africa that do not have any access to loans. As an economist, there is nothing more else. It's a textbook example. It's a perfect textbook example for a credit crunch situation. So having robust financial markets is key, I guess, for having a significant impact when it comes to develop these countries. And so I believe that should be one of the focus for the next years, especially from the MDB side, for the NDBs, to give them more or less here expertise, what we can do. We should also be very creative. We should, I guess, it's also true what I heard from the private sector side, I guess we need new products, we need innovative products that are really serve the needs of developing countries. And so I believe, as I said, it's a huge challenge. It's not, I think it's a lot of money is necessary, much more that is currently being provided. This is also true. And I come back to my central banker side, and I believe that the next years will not become much easier in that regard. Currently, we are in a excess liquidity situation. We have ample of money in the market. But as you all know, many central banks are now thinking about to withdraw the money, to do their lift-off and do their exit strategy. So I believe we are more or less entering into a more volatile financial situation. So I believe the MDBs and the NDBs have to work much more closer than they did in the past.
Joachim?
I think that there are many ways to do, as you mentioned before, technical systems working together. You just mentioned the development of capital markets. We, in particular, in many places, working there because we understand that it is very important both for, say, manufacturing companies and these kind of things, which will be more with our colleagues from IFC, which in many cases do work with the national development banks. But also, going back, when you think about infrastructure, and I think that the real challenge these days is the development of innovative products. And there I think we can work with the national development banks. We have some experience of doing that. To the extent that you can provide sometimes, for instance, mechanisms to facilitate the financing in local currency, or instruments that decrease the risk, say for a sponsor for a company that runs a concession, of taking some hard currency loans, because we can provide a liquidity facility or the mechanism that can protect this company, this operator of infrastructure, when you have an exchange rate shock, when you have other types of shocks. These are very clear ways to be working with NDBs, and I think we have developed a dialogue, and we have to do more of that. I mentioned at the beginning the Hamburg principles and how we mobilize the private sector. I think the insight that the national domestic banks often have a better understanding of the landscape is one of the examples where you have a different comparative advantage, and by working together, by trading our say skills, we both benefit from this different comparative advantage and have a more impact. And I think one area also where it's very important is related to climate change and resilient quality infrastructure, because more and more this will be important, that you build things that will last, that respond to the needs of adaptation, and finance also things that actually mitigate the risk of climate change. And there again is where we have to work together and mobilize the private sector as partners. The awareness of the private sector in relation to climate change has changed dramatically in the last 2 or 3 years. 3 years ago, these few companies would really talk about these things. Now most companies, most countries are acutely aware, are willing to engage into that. So I think these are 2 or 3 things that really make a difference. And again, taking what Gerardo mentioned, if you get multilateral, and also Clemente mentioned too, if you take a multilateral and a national, or bilateral is the case, and a national development institution, and they get together to some sort of a program, some sort of a plan. I mean, we know that, especially when you have a government with fixed and relatively short mandate terms. I mean, you have election every 4 years. Infrastructure, 4 years for infrastructure means nothing. And often the incentives for those who are in power are very difficult. So a good partnership between multilaterals, bilaterals, and the polylaterals development banks is exactly create an environment where you can see the medium and medium long term, and as in so many cases, marketing usually doesn't happen in the vacuum. You have the private sector when they can see some structure, when they see some institutions, because then they can focus again on their comparative advantage, looking at the specific risks. So these are the ways we can work together.
NDBs work a lot. We should work more with the national development banks on this. The second idea is, how can we enhance the trust
afternoon, ladies and gentlemen. Thank you so much for your presentation. My name is Rosemary Segero. I'm a president of a company called Segero's International Group. We focus on small and medium businesses globally. Thank you so much for German initiative. I have communicated with the P20 and G20 on this issue. How can the national development banks globally put their resources and have a policy that can support small and medium businesses for growth, especially in developing countries? Even global small and medium businesses have challenges all over the world. So how do you include us and involve the private public sector banking institutions? Thank you.
Okay, SME finance. Anybody else? If not, we will ask. Okay, you're the last one, sir.
I tried to be very provocative. I really need $1 trillion, or just 1,000 million? I mean, are you not putting quantity over quality in the investment? Because I just came from a session from the case of Israel about the innovation, the startup nation, and there they are talking about 1,000 million projects that are doing a lot of impact in terms of economic development.
It's true, but as I said before, sovereign wealth funds, pension funds, and reserves globally are estimated at 60 trillion. So 1 trillion for infrastructure in developing countries, not such a big deal. Anyway, I'm not a panelist, but that would be my answer. Okay, SMEs first. Anybody on SMEs? And then water comes to you. And then addiction. Yes. Addiction. Yes. Okay, you want to try SMEs?
I thought that I already tried to answer your point. I think it is essential to strengthen local financial institutions. I think this is key for having, let me say, a proper funding structure in the country, to have proper lending to SMEs. So I think the objective of our institution could be to get into those institutions in your countries, like in Africa, what was proposed during the G20 initiative. But this year, I think this is the most important thing, maybe to make the institutions within the country much stronger. As I said, it's not sufficient at the end that the, let me say, stimulus is just coming from outside investors. This is something, this is not a long-lasting thing, and so I believe the more effective thing is to make the institutions on the governmental side, but also on the private side in the respective countries, much stronger.
Okay, Patrick?
Yeah, just a quick one. I think we all understand and acknowledge that SMEs are the job creation engines in any nation. You can ask Germany, you can ask Japan. You will appreciate that 85% of the economy is being carried by the SMEs. So the need for funding for SMEs is such a critical necessity, and more so for the continent of Africa, given the levels of poverty that we currently are still faced with. But again, we also have an unacceptably high levels of venture capitalists that could really be funding these SMEs. But I think it is something that we want to work very hard with the governments of the continent to see how best we can be able to cooperate with our global partners to make actually the hopes of the young Africans actually viable through the funding of FMEs.
We should talk later, but there are SMEs and then there are SMEs. I'm in favor of funding for startups. I'm not in favor of funding for SMEs that have been SMEs for 20 years and have not made it to scale, in which case Schumpeter said they should go out of business. Okay, water.
Okay, before I touch on water, actually, there's a question. So when do you actually exit, right? Otherwise, it's a sunset thing. So that's why I come back to the point. I think it's important to have this developmental reporting, because once you reach a stage whereby the borrower that you have funded is able to be funded by the private sector, that's the time that the development bank has to exit from that transaction. Because otherwise, it's too easy to get the client and you can stick with the client for the next 20, 30 years. And as you said, you don't develop the client. I think there's very little that has been done in terms of nurturing the client. I think that's where a lot of efforts needs to be focused on nurturing these clients, so that we don't end up SMEs that are just maintaining the same profile for the next 20, 30 years. Right? On the issue of water, so in Malaysia, of course, we have taken the step of privatizing water, not to a very popular public, of course. One point I wanted to mention, yes, we have used sukuks in order to be able to raise funding for water. However, I think there's one specific example. One of the reasons why, Malaysia is blessed with a lot of rain, but however, it has water problems. So why is that the case? One of the reasons is actually because of environmental pollution, right? Because of the environmental pollution that's happening, the water levels are down. And that's primarily because of a lot of infrastructure project that's going on. So essentially, we are having to raise two types of funding. One type of funding is actually to fund infrastructure like highways and so on. And the next funding is to be able to then essentially make up for the mistake of the environment in order to then raise money for water, right? So the right thing to do, which we are going to embark on, is actually the Ministry of Environment has actually published a blacklist of people who pollute in the economy. However, none of the financial institutions have actually implemented this. So what we will be doing is that in any of our project finance, if any of the borrowers, either the main contractor or the subcontractor, is listed in the Ministry of Environment's blacklist, we should then not allow them to participate, because essentially the public is then allowing, we have a role as a development fund institution to be able to stop this, right? And this is something. Otherwise, what we're doing is that we're having to raise, as I said, one funding for infrastructure and the other one funding to make up for the mistakes of other people.
Okay, I'll let the two of you speak afterwards. Please join me in thanking this panel. On this? You going to comment on this? Oh, addiction. Okay. Hang on. There's an answer on the addiction problem. Clemente will answer the question of, can you get addicted to a national development bank?
Of course you can get addicted, and I think we've seen example. No, what I was going to say, in the case of FDN, when the government and IFC started to design the evolution of the institution, one of the decisions was, in 6 or 7 years, this company should be IPO, should go to the markets.
Okay.
And why? Because the idea of the IFC is maybe at that point the importance of the development impact is lower, and maybe the institute should evolve into a commercial or specialized infrastructure and not so much a developmental. What I think is interesting is it puts a challenge in time to really put the shareholders to challenge themselves in 6 or 7 years whether you still are needed, and if you are still needed as a development bank, maybe the government needs to buy back the IFC. That's what the IFC said, and I feel it's an interesting way of at least putting some pressure on thinking of what should be in the future.
Okay. Thank you all for coming. Thank you. Sorry, I was trying to close it and I forgot about it.
It wasn't interesting.
Yeah.
Thanks for making it more interesting. So,